And I know times like this you just take it slow. I fall asleep in the pillows. She got my heart in a chokehold. And there she goes.
Assalamu alaikum. Hello everyone. This is Liquidity Club by Ahmed Shawi. Today is Sunday, the 17th of December 2023. I'll be doing the weekly market review and we're gonna go in depth with what I'm expecting the market to unfold in the upcoming weeks. So let's get started. Starting with the DXY. I have the weekly chart. As you can see, we walked inside the fair value gap and we left it. We took this inside liquidity, and as a result we formed a long discount wick. It has just moved to my anticipations. Now if we close, we trade next week and we get a daily closure below the weekly consequent encroachment of this discount wick, I'll be expecting price to run towards the fair value gap as a drawn liquidity, as means of drawn liquidity. And if we see price animated to the drawn liquidity, which is the fair value gap, I'll be expecting it to be treated as resistance, either the low or the consequent encroachment of the fair value gap that can potentially send price lower to the sell side liquidity. And inside below the sell side liquidity, we have a fair value gap. If you go back in the past, you will see this fair value gap. I'm not gonna go and do it here, but this is what I'm expecting mainly in DXY. Going to the daily time frame, as you can see here, we've swept the buy side liquidity. We left this buy side liquidity and we traded lower. Last week, I told you that if we close above this high, I'll be expecting price to continue running up higher, but we didn't get that. As you can see here on Wednesday, price traded and closed below the fair value gap. And I mentioned that if we close below this fair value gap, or even below the mean threshold of this bullish order block, you can go back to the previous weekly review and you can review what I've mentioned. But I mentioned that if we get a daily closure below the mean threshold of this bullish order block or the fair value gap, I'll be expecting price to continue running up lower, running the sell side liquidity. And we got that perfectly here. You can see the Wednesday closed below the fair value gap. Next day, Thursday, price was in a rush to reach to the sell side liquidity, and it even opened with a gap. So we have a volume imbalance also here. Keep note of that. That's a fair value gap from this candle's low to this candle's high, unless there's an exception of the volume imbalance that is residing right there. So we formed the volume imbalance and we traded lower, running the sell side liquidity, and we were close from the weekly fair value gap drawn liquidity. Now I want to see price close, get a daily closure below the weekly consequent encroachment to treat it or to expect it as a bearish, that we can be expecting price to run for the drawn liquidity, which is the weekly fair value gap. You can notice that the weekly fair value gap here on the daily time frame is the bullish order block. Now this is the reasoning and this is the justification why we use BD arrays for entry purposes and also for targeting purposes. So if price would want to run below these lows, and what would be your target? Because there is no fair value gap and the sell side liquidity is a bit far from actually the fair value gap. So what would you be targeting? The bullish order block. So we look at the bullish order block as entry purposes when we were trading in August, and as targeting purposes when we're trading below, and targeting it when we're trading to it. So this can be used as an inversion bullish order block. As you can see here, if you look at this market structure, this looks like it is the market maker sell model. Anyway, we have a bearish breaker right there. We have a high, formed a low here, higher high. You can see that it peaked above the highs. This is what matters the most, because in these small wicks that peaked above, or the mohawks that are above this high, there are buyers, the buy stops that were residing above here, and the stop loss that is also residing up there. People who were trailing their stop loss, who caught this short and price has broke lower below this low, they will be trailing their stop loss above this high. Price went up higher, and once price break above this high, many people are going to be looking at this as a bullish breakout artist, and the people who are just plainly following patterns for the pattern's sake are going to be looking at this as a bullish breaker, when in fact it is not. And when we were trading here, I told you that I don't pick a side here. I'm waiting for price to show me its cards so I can be dealing with it. And in fact, I told you, if price does this, I'm going to be expecting price to run for the sell side liquidity. If price does that, I'm be expecting price to run for the buy side liquidity, walk inside the fair value gap and reach the bearish order block. And we got that. This is how you trade properly. You're not anticipating, or let's say you're not curious about what the market is going to be doing. No, you are sure about that. If price does this, then it sure is going to be doing that. Anyway, we have a bearish breaker right there. Even the people who we run above this high, they have went long here. At the moment we traded above it, trying to get in early, and they're setting their stop loss below this low. So we cleared the liquidity that is residing above here, and then we traded lower, attacking this low, neutralizing all of the sell stops that were residing from the people who went long above this high. Now we're tracing to the bearish order block. The bearish order block is going to be these 4 consecutive down close candles. You can mark them on your charts and you can look at them. So price is now retracing and walking inside the bearish breaker. Now I don't want to see price close above the mean threshold of the bearish breaker. If it was really meant to be trading lower, the mean threshold of the bearish breaker is sensitive, and once it trades to the mean threshold of the bearish breaker, we would want to see some reaction. And you can see roughly the mean threshold of the bearish breaker is the high of the fair value gap, and you can see that we'll be targeting now this low formed relative equal lows with these 2 lows. So we'll be targeting those sell side liquidity, those relative equal lows with this one, and the fair value gap, which is on the daily time frame, is a bullish order block. So I'm mainly bearish on DXY unless we close above the bearish breaker high. If we do get that, then I'll be reconsidering, because the high of the bearish breaker is also the mean threshold of the bearish order block. And if we get a daily closure above the mean threshold of the bearish order block, then it's likely that it's going to be continuing running up higher to fill some of the liquidity that's residing up here and walk inside the fair value gap. But I've explained why I'm looking for lower prices. So I think that's going to be pretty much it for DXY. Going to ES, here I'm viewing the continuous contract, and I'm also viewing the monthly time frame chart. For your info, for the people who are trading futures and are viewing my channel, we've switched to March contract, which is in ES would be ESH 2024. This applies to NQ and Dow. Anyway, I'm viewing the monthly chart to show you that we have reached to our buy side liquidity, as I've been calling for some time right now. We have another buy side liquidity right there, and we have the final, or let's say the terminus, this buy side liquidity. This, if we run up this high, will be forming a new all-time high. So the all-time high is now this level right there. So it's very important to keep these levels on your chart for future references. Going to the weekly time frame, as you can see, the buy side liquidity that I've been calling out for weeks now, since we were trading right there. I've been calling out for this buy side liquidity, these 2 buy side liquidities, and we've just been attacking them. You can see since, let's say, mid-October or late October and until mid-December, all we're posting are high or up close candles, you can see, which means there's sponsorship from smart money or the central banks to actually accumulate this index. So we've run the buy side liquidity, the rejection block also, and the buy side liquidity. Now price can either consolidate, it can retrace, it can expand, but I'm still looking for high prices towards this buy side liquidity and this buy side liquidity. But right now, after we've swept let's say a considerable amount of liquidity that are residing above this high, we can now consolidate or get a retracement at least to, let's say, push some interest into the marketplace, because the market cannot be trading higher all the time. It has to gyrate around and retrace to create some kind of a sentiment or interest in other traders, because some other traders will be looking at this as a missed opportunity, and a missed opportunity is a lost opportunity. So they would want to, let's say, create the interest in the marketplace by retracing and gyrating around the marketplace, so they can build more liquidity that it can be, let's say, used and utilized to run to their intended drawn liquidity. So anyway, right now I'm not forcing any bias or narrative, especially after we've run this buy side liquidity. I can expect some kind of a consolidation or retracement at least towards this fair value gap. Maybe then we can run up higher, but we are like, if you consider this high to this fair value gap, we're close to this high from this fair value gap, so we'll be looking at it. Going to the daily time frame here, and I want to show you something that basically negate the idea that the market are random. The markets are not random. They're highly efficient and precise in delivering price, and I'm going to show you how. You can see the how price trades up higher, consolidate a little bit, which is very normal to see price consolidate. And if we consolidate near buy side liquidity and this buy side liquidity, this means that price is likely to trade up higher and take out the drawn liquidity or the buy side liquidity here in this case scenario. You can see that we have a bearish order block here from the past in August. You can see in August we have a bearish order block. The price trades to the bearish order block right there, and we see some reaction. Price trades a little bit lower. It trades to the consequent encroachment of this discount wick, and then ran up higher and took out this high, and basically traded through the bearish order block. This would be the low of the bearish order block. It has traded through it, and you can see on this candle it has closed above it. What do we know about inversion BD arrays? Is that if market price or the market closed above them, we will expect price to treat them as an inversion BD arrays. So it would be expected to treat the bearish order block as means of resistance level. So as you can see right there, when price traded to it right there, it was showing resistance and price traded away from it. Later it has traded to it, visited it one more time here, but it was very weak to reach to it, and it just kept pushing it away. So it was showing resistance. When we traded here, the same resistance we've seen it, but it was shallow. It wasn't like the resistance that it was showing it here. Later we have run up through the bearish order block low, and we've treated the low as support, and we continued pushing up higher. We had a volume imbalance. The same thing is mentioned. Volume imbalance here from this candle's, let's say, close to this candle's open. That's the volume imbalance. Extended that in time, and you can see how we closed above it. Next day we treated the high of the volume imbalance as support, and we continued running up higher, attacking the buy side liquidity. You can see how we opened, traded lower to the high of the volume imbalance, to the tick. You can go to your charts and you can see it. it has traded to the high of the volume balance to the tick. Now that cannot be random. There is a high efficient algorithm that is driving price, and the volume balance was one of those reference points, that price or reference levels that the algorithm was referring to when it was delivering price to this buy side liquidity. So you can see how price has treated, this is the best example of how price has treated the BT arrays as inversion BT arrays after we traded above them. So this is going to be pretty much it for ES. Going to NQ, here I'm viewing the continuous contract and I'm also viewing the monthly time frame chart. As you can see, we've reached the monthly breaker high. We took out the buy side liquidity right there, and we are now trading to the rejection block and to the buy side liquidity, which is all-time high. You can see that we've closed above this fair value gap. Later, when we've created this fair value gap, price was just showing an institutional order flow into the here. It has traded away. Later it retraced, traded to the monthly fair value gap and traded away. But now, however, we traded to the high in November, and then we retraced from the high. December we've opened, traded lower, and then we rallied up higher. We still didn't close the candle, so there is still 13 days until closure of this candle, but we can, if price closes above the monthly inversion fair value gap and or the monthly breaker high, we'll be expecting them to be treated as support levels that can send price higher. You can see that the high of the monthly inversion fair value gap we can be looking at, if in January we can be looking at immediate rebalance. So if this candle closes with a fair value gap, with a potential fair value gap, January can be retracing to the high of the inversion fair value gap, forming an immediate rebalance with November's candle and trade up higher to the all-time high and form a new all-time high. So, and we've also, if we close above the monthly breaker high, both of these, the monthly breaker high and the monthly fair value gap, which would be considered as an inversion fair value gap, those BD arrays can be used as inversion BD arrays that can send price higher towards the rejection block and to the buy side liquidity. Going to the weekly time frame, as you can see, we've closed above. I'm going to show you on the daily time frame. I was considering between the week consequence of the premium and the discount, and we've got the discount first. We traded lower, trade to the fair value gap, and we formed a discount wick, long discount wick. And I was telling you in the last weekly review, if we get a daily closure above the premium wick, consequent encroachment, I'll be expecting a continuation towards and take out this buy side liquidity and reach to the buy side liquidity and the monthly breaker high. Or else, if we trade lower and we get the daily closure below the wick consequent encroachment, I'll be expecting price to walk inside this low and perhaps retrace to a deeper fair value gap and to this bullish order block. But we didn't get that. We got, let's move to the daily time frame. You can see how we have traded up and closed above the wick constant caution. You can see that on this candle right there, price showing a bit of resistance. When we traded, we were very close from it and it showed some resistance there. Next day we opened, closed above it, traded lower, closed above it, and we even closed above the monthly inversion fair value gap. You can see that the next candle, which is Tuesday I believe, we opened, traded lower to the monthly inversion fair value gap and to the high of the buy side liquidity. So it was used as an inversion, and then we traded up higher, taking this buy side liquidity and reaching to the monthly breaker high, and then slowing down as we reach to Thursday and Friday. So my objectives has been met in indices, so in ES, NQ, and now I'm going to show you Dow. We've just seen price move as we are anticipating, or as I am anticipating, and I've been calling out the markets for months now, if you go back months in advance, you see me that I have provided what the market is going to be doing all that time. Since June, I've been sharing and I've been providing what I'm expecting from price to be doing in the future. And we've in fact seen that happen in price. So right now, since price has reached to our targets, it's very crucial and important to actually take a moment and reflect, journal, and look into those winners that you got. Maybe you traded. Honestly, I have multiple trades that I took last week, so it's a great opportunity for you to actually journal those trades if you didn't already. Reflect upon those trades and try to analyze them. Understand what you did wrong on those trades. Do less of that. Analyze and get a feeling of what you did right on that trade and try to do more of that by the time you be developed as a good trader. So try to take your time, do something fun, because we've reached to let's say significant pool of liquidity, and we are expecting after expansion to get some kind of retracement or consolidation. You can see that after we run this buy side liquidity right there, all of this buy side program that was occurring in price action, we run out this buy side liquidity, and this buy side liquidity we went into retracement to the weekly fair value gap, and then we expanded higher because the algorithm is looking at this buy side liquidity. Now we can get another retracement or a consolidation, then a break lower below the consolidation to trap all of the sell stops, and then run up higher, continue running up higher to the rejection block and to the buy side liquidity. This is how the market is moving. Sure, you will get the market, let's say, quarterly shift that is going to be happening every 3 to 4 months, but you have to look always at your drawn liquidity levels and just go with that. So that's going to be pretty much it for NQ. Going to Dow, here I'm viewing the continuous contract and I'm viewing the monthly time frame chart. As you can see, we have traded below this low in October time period, and then we traded up higher, forming a bullish breaker. So those two consecutive down up close candles are a bullish breaker, and we have a buy side liquidity which is all-time high residing up there. So I'm bullish. I'm expecting price to run up for this buy side liquidity. Going to the weekly time frame, you can see how we run this buy side liquidity. We run this buy side liquidity, and now we're expecting price to run for this buy side liquidity right there. From a fair value gap, you can see that that's pretty much what I'm expecting. We have a mitigation block right there. These 3 consecutive down close candles, we have low, high, higher low. It's not a lower low. If it was a lower low, this would be a bullish breaker, but it's not a lower low. It's a higher low, which means this is a bullish mitigation block. Price can retrace if it wants to, but it's very close if you would consider from this level point to the buy side liquidity relative to this closing level last week to this weekly fair value gap and the mitigation block. It's closer to the buy side liquidity all-time high compared to the buy side liquid or the bullish mitigation block and the weekly fair value gap. So price would be expected to run for this buy side liquidity, but I'm still expecting if it wants to retrace, it can retrace to this weekly fair value gap and to the bullish mitigation block, accumulate positions, and then run for the buy side liquidity. Going to the daily time frame, it's just the same thing. Pretty much there's nothing to be said. You can see how we run the buy side liquidity here, the buy side liquidity here, and this is my drawn liquidity. I'm trying not to spend much time on Dow because it's a market that I don't trade. I'm just using it as a benchmark to my trading in ES and NQ. So, but I have to look at it, and I have to understand what is price is trying to do here on Dow, so I can get a feeling of what I can do on the other markets. And if we are bullish on Dow, that means that I can proceed with my analysis, and there will be no conflict of interest between Dow, NQ, and ES. So if Dow is showing me or telling me that we're bullish, that would be telling me that we're in sync. So if I'm bullish on ES or I'm bullish on NQ, and I compare that to Dow, and I'm also bullish on Dow, that is telling me that I'm in sync, and it's likely to see some more of a high probability trades in my favor. So that's going to be pretty much it for Dow. Going to EURUSD, also known as the fiber. I'm viewing the weekly time frame chart. You can see that the candles here, the bodies, especially the bodies, are respecting the weekly fair value gap and are respecting the bullish order block. You can see that the refined bullish order block once we drop down to the daily time frame, and we've traded up higher. We were very close from reaching to this buy side, which we formed relative equal highs. You pay attention to this high right there, last week's high. Pay attention to that, because we're going to be comparing it to British pound USD, or also known as the cable, once we transition to pound, to the review of the cable. So if price wants, and I honestly would be expecting price to run up higher to be bullish, I need to see price close on the daily time frame above the wick constant. If we get a daily closure above the wick constant and it's showing support at the wick constant as support after we close above it, that is going to be suggesting to me that we're likely going to be running up the relative equal highs, because also at the level relatively and approximately, the wick constant is roughly the rejection block level here. So they will be utilized as an inversion bid arrays that can run price higher towards the relative equal highs, buy side liquidity and this buy side liquidity. So going to the daily time frame, as you can see, my objectives has been met. Last week I called out that price has traded to the bullish order block and to the refined bullish order block. You can see the reaction to the high with the bullish order block. It has traded to the pip, and then retraced from it. You can see the bodies are respecting. This is telling me that we're bullish. We retraced. You can see the bodies are respecting the weekly fair value gap. The weekly fair value gap from this candle's high to this candle's low, it's just been transitioned and dropped down to the daily time frame. You can see the bodies are respecting it. Sure, the wicks are doing the damage here by tracing lower, because we have a continuation to that weekly fair value gap here on the daily. It's another fair value gap, and you can see that we have a bullish order block. So price, how far can it go? The wicks, how far can the wicks go below weekly fair value gap? Look at the daily bullish order block. If there's a bullish order block or there's a breaker or something of that effect, price is gonna be likely reaching to that by the wicks, but the bodies are gonna be respecting the weekly fair value gap, as we can see right there. And I was calling out that I'm gonna be looking at the fair value gap, this as a draw liquidity, and this buy side liquidity. Now we didn't reach to that buy side liquidity, but we were very close from it. Now, as I mentioned earlier, I want to see price close above the wick constant. If it does, I'll be expecting price to run those relative equal highs, and also the wick constant of this premium wick, the buy side liquidity and this buy side liquidity. So I'm not holding bullish prices, but if we close above the wick constant of this premium wick, I'm holding higher prices and I'm looking for this buy side liquidity, this buy side liquidity, and this buy side liquidity. If we don't, if we traded to it and we showed some resistance, then I'll be looking for a retracement. But I don't like how price left those clean. There are buy stops that are residing above these highs, so I don't think the market's going to be leaving them right there and going lower. Anyway, that's going to be pretty much it for EURUSD. Going to pound USD, also known as the cable. Here you can see that the cable actually took out the high and was actually very close from this buy side liquidity. If you compare it to euro, price is nowhere close from this buy side liquidity, and it hasn't even gotten above this high. But on pound USD, it has took the buy side liquidity right there and was very close from this buy side liquidity. You can see how the bodies are respecting the weekly fair value gap, or let's say the weekly inversion fair value gap after we closed above it. The bodies are pretty much inside the weekly inversion fair value gap, they are not going below it. The wicks are respecting the weekly fair value gap from this candle's high to this candle's low and trading up higher. Going to the daily time frame, you can see the same thing. The bodies are respecting the weekly fair value gap. The wicks are just trading lower to trade to the bullish propulsion block and the bullish order block. You can see how it's just the low of this candle is just reaching to the bullish order block to the pip, and then it has traded up higher, attacking this buy side liquidity, and was very close from this buy side liquidity. So now we formed relative equal highs. This buy side liquidity and this buy side liquidity, we formed relative equal highs. Price is likely going to be, we have a small fair value gap here. Price can be trading lower, filling some of that fair value gap, maybe have some of immediate rebalance with this high, and then trade up higher, run up those buy side liquidity and this buy side liquidity. So I'm looking for higher prices if the DXY can cooperate with us and give us, let's say, lower prices, which would equate and result in higher prices in Euro USD, also known as the fiber, Pound USD, also known as the cable. It would be diametrically opposed to the, let's say, the pairs in Forex that start with the USD. So USD Yen, USD CAD, etc. So I think that's going to be pretty much it for this weekly review. I want to add some notes that we're closing the year. We've entered the last 2 weeks of the year, and usually within that period of time of the year, we can expect some kind of a low volume because we're entering into a holiday, and many of the large funds are going to be, let's say, finishing their business early and trying to get into the holiday. So they will be pulling all of their pools of liquidity. They will be lowering their exposure to the marketplace. So let's say there's a pool of liquidity here, they were shorting, let's say, and they have their buy stop above this level. They will be, let's say, decreasing the exposure to the marketplace by, let's say, if they were selling here, they would be buying right there a little bit to reduce the exposure to this buy side liquidity if price reaches to it, and their stop loss is above this high, so they will be losing less. If they closed some of the position right there and close the rest here, if price wants to attack it, they will be losing less when compared to closing the full position above this high. So in short, in layman's terms, large funds are going to be lowering their exposure entering to an holiday. So whenever you're entering into a holiday, you will see that large funds are going to be lowering their exposure, and as a result of that, as an effect, you see price not really much moving to your pools of liquidity that you're looking at previously. So now I'm looking at these pools of liquidity, this high and this high. If large funds wanted to pull their liquidity that is residing above these levels, or let's say reduce their exposure, price might not reach to it as soon as possible, because maybe let's say last week there was a pool of liquidity that is considerable amount of liquidity that's residing above this high, but let's say next week they are lowering their exposure, so the market has no urgency, has no importance to reach to that level ASAP. So it can retrace, it can engineer and, let's say, create sentiment, engineer interest in shorts, and wait for large funds to get back on the markets after holidays, so they can engineer the their liquidity pool that they took off, or their exposure, to rebuild it and let's say to put it at this buy side liquidity, which will then create that urgency in the algorithm to reach and attack this buy side liquidity. So I try to explain it in a way that can be understandable by many people. I think that's gonna be pretty much it for this weekly review. I hope you found this one insightful. Until I talk to you next time, be safe. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh.